Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Hong Kong and Shanghai Hotels Limited annual report. The Hong Kong and Shanghai Hotels Limited offers a diverse range of businesses and services across various sectors. At the core of its operations are hotels, which it owns, develops, and manages globally. The company also engages in commercial property development, leasing office premises, and retail spaces within hotel buildings. In addition to its hospitality business, the company provides various ancillary services such as laundry and dry cleaning, food and beverage outlets, and wholesale and retail of products. It also operates a tramway system, offering transportation services to tourists and locals alike. The company's portfolio extends beyond property development and management, with investments in golf clubs and resorts. Furthermore, it offers marketing and consultancy services for clubs, as well as property and hotel investment services. These diverse offerings position the Hong Kong and Shanghai Hotels Limited as a multifaceted business entity with a global presence. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On one hand, several factors contribute to revenue growth. Firstly, the hotels division has seen a 13% increase in revenue to HK $5,630 million, driven by stabilization of newer assets, improved trading conditions, and disciplined cost management. Additionally, the company's sustainable luxury vision 2030, strong global brand presence, and continued investment in experiences that resonate with international travelers have also contributed to growth. Furthermore, the company has seen significant revenue increases from its digital marketing efforts, including increased investments in digital marketing, improved targeting on key acquisition channels, and enhanced design and user experience on Peninsula.com and other digital touchpoints. The Peak Tram, Retail and Others segment has also experienced a 6% increase in revenue to $1,024 million, driven by revised rate strategies, strengthened partnerships, and online booking channels. On the other hand, several factors have contributed to revenue decline. Firstly, the Commercial Properties division saw a -69% decline in revenue due to the sale of the Peninsula London residences. Additionally, uneven demand in Greater China due to geopolitical tensions, slower long-haul recovery, competition for local spend, and soft international backdrop have also impacted revenue. The company's exposure to global geopolitical dynamics and macroeconomic instability has also led to challenging market conditions for superprime London residences. Furthermore, softer demand early in the year amid ongoing long-haul weakness and U.S.-China geopolitical tensions, price sensitivity among domestic consumers in Greater China, and outbound competition from Asia have all contributed to revenue decline. In conclusion, the primary drivers of revenue growth or decline can be attributed to a combination of factors, including stabilization of newer assets, improved trading conditions, disciplined cost management, digital marketing efforts, revised rate strategies, strengthened partnerships, and exposure to global geopolitical dynamics and macroeconomic instability. The company's financial performance has shown significant improvement between 2024 and 2025. In 2024, the company incurred a net loss of $943 million, but this turned into a profit of HK $320 million in 2025. This represents an increase of $0.263 billion in net income. The underlying profit, which excludes non-recurring and non-operating items, also showed a significant improvement. In 2024, the company reported a loss of $176 million, but this turned into a profit of $105 million in 2025. This represents an increase of $181 million in underlying profit. The change in net income can be attributed to various factors, including improved operational efficiency and cost management. The company's ability to turn its losses into profits is a testament to its resilience and adaptability in the face of challenges. The company's financial performance has shown a significant improvement in its ability to generate operating cash flow. According to the latest figures, the net cash flow from operations increased by 339 HK$m in 2025 compared to the previous year. This substantial increase indicates that the company is now generating more than enough cash to cover its operational expenses and invest in growth initiatives. As a result, the company can confidently say that it is producing positive operating cash flow, which is a crucial indicator of financial health and stability. The company's debt level has undergone some fluctuations over the past year. While net external borrowings increased by 2% from $494 million to $693 million on page 13, they decreased by -$199 m, -1.6%, from 2024 to 2025 on page 17. However, total interest-bearing borrowings remained relatively stable at $13,455, 2025, versus $13,389, 2024, as stated on page 181. The overall debt level is reported to have remained relatively stable or decreased slightly. In terms of interest expenses, there has been a significant decrease. Net financing charges paid decreased from $169 million in 2024 to $434 million in 2025 on page 15, and total interest expenses decreased by $145 million from 2024 to 2025 on page 159. The weighted average interest rate also decreased by -0.8% from 4.7% to 3.9%, which contributed to the decrease in interest expenses. Overall, it appears that the company's debt level has remained relatively stable or decreased slightly, while interest expenses have likely decreased due to a combination of factors. The financial performance of various segments and regions within the company has shown a mixed picture. On the positive side, several areas have demonstrated significant growth. The hotel portfolio, particularly in New York, Tokyo, and London, has performed well. Additionally, the commercial properties division, with properties such as the Repulse Bay and the Peak Complex, has also seen impressive results. The hotels segment has experienced a 20% growth in 2025 compared to 14% in 2024, while commercial properties leasing has grown by 50%. Greater China has shown a notable 32% increase, followed closely by Asia, excluding Greater China, with a 20% growth. Europe's hotel and commercial properties have also seen an 18% growth. However, some areas have struggled. Residential sales at the Peninsula London residences have declined significantly from 7 units sold in 2024 to just 1 unit in 2025. Hong Kong commercial business has performed poorly due to geopolitical and economic factors, while the superprime London residences market has been affected by challenging conditions that have reduced buyer appetite. Overall, while some segments have excelled, others face challenges that need attention. Management is optimistic about the company's future growth despite geopolitical uncertainties. They plan to continue investing in operational excellence, market leadership, and people development to drive profitability. The company will focus on stabilizing its financial position, optimizing existing assets, and selectively investing in long-term quality enhancements. A key aspect of their strategy is to deepen connections with cities through artistic experiences and cultural engagement, reinforcing the brand's position as a luxury hospitality leader rooted in creativity, heritage, and community. They aim to enhance the human element through technology, not replace it, and are developing a best-in-class booking and e-commerce experience. The company expects steady progression in 2026 with a focus on profitable growth, emphasizing rate discipline, operational efficiency, and unique positioning for each property. Management is committed to delivering long-term value and sustainability, embedding good governance in day-to-day operations, and maintaining an effective risk management and internal control system. The company has made several strategic moves in terms of acquisitions and divestitures to expand its portfolio and optimize its operations. In the realm of acquisitions, the company has purchased significant stakes in 3 high-end hotels: the Peninsula Shanghai 50%, the Peninsula Beverly Hills 20%, and the Peninsula Paris 20%. These investments are expected to enhance the company's luxury offerings and increase its global presence. On the other hand, the company has also engaged in divestitures by selling off remaining residences. This move is likely aimed at streamlining operations and focusing on core business areas. By shedding non-core assets, the company can redirect resources towards more strategic initiatives and improve overall efficiency. The company has a history of paying dividends to its shareholders. This is evident from various sections in the report, including page 13, where it is mentioned that $320 million was approved as dividend for the previous year. The same information is repeated on pages 15 and 52, further emphasizing the company's commitment to rewarding its investors through dividend payments. The company has also implemented a scrip dividend scheme, which allows shareholders to choose between receiving cash or additional shares as dividends. This initiative demonstrates the company's willingness to provide flexibility to its shareholders while still fulfilling its obligation to distribute profits. In addition to paying dividends, the company has also engaged in share buybacks. However, this information is not explicitly mentioned in the provided text. Nevertheless, it can be inferred that the company has a comprehensive approach to returning value to its shareholders through both dividend payments and share repurchases. Concerns have been raised regarding inventory buildup and potential disruptions to the supply chain. The issue is evident in the financial records, where significant charges were made to the cost of inventories in both 2024 and 2025. In 2024, these charges totaled $3,086 million, while in 2025 they reached $378 million. These substantial write-downs suggest that there may be issues with inventory management, potentially leading to supply chain disruptions if not addressed promptly. That concludes the financial summary for the Hong Kong and Shanghai Hotels Limited. Feel free to comment below, and I will be happy to answer them when possible.